So is the real lesson from this crisis that liquidity was the big problem?
Liquidity wasn't the only problem, but I think a lesson that investors have derived from this crisis is that it is very important to be aware of what your liquidity situation or the liquidity situation of your portfolio is in any given point in time. I think some investors have learned the hard way that it's not the same thing to be invested in an equity vehicle that is liquid versus an equity vehicle that is non-liquid. And if you have too an illiquid portfolio, if you are going to need suddenly liquidity, like has been the situation for many investors in the current crisis, then you're going to find yourself, you need to sell your assets at the time where you're not going to find buyers that are willing to buy maybe those assets at what you think should be the fair value of those assets. That leads to fire sales, and that leads to big losses for the investors who are forced to sell. So I think what prompted the crisis obviously have been fundamental factors. But one of the consequences that those investors who had not thought through well the liquidity exposures in their portfolios have been among the investors who have been the heaviest losses, have been suffering the heaviest losses, or has been in the worst situation in this crisis. So yes, I think one of the big lessons from the crisis, and I think the investors are taking note, especially institutional investors, how you think more carefully about whether you are long or short liquidity. And it seems like being short liquidity a little bit too much can have disastrous effects when a situation like the one we have lived in throughout the end of 2008 and the beginning of 2009 we have been going through. Yes.
We've seen a lot of famous investors that have fairly illiquid portfolios, real assets but illiquid portfolios, lose a lot of money. Do you think that those type of investors, like the endowment foundations of Yale, remain a good model, or is the model in need of change?
The model remains a model to think carefully about it. I don't think they are going to change their model. I think essentially their model is sound. It's a model based on diversification across asset classes. It's a model where you think carefully about, as a long-term investor, that you can assume some illiquidity. I think, as I said before, liquidity is important, but you need to calibrate, depending on your needs, how much illiquidity you can assume. And certainly these investors have been liquidity providers in the past, and I think they are going to continue doing so because they can afford to do so, given their long-term investment horizon. Now, what we're going to have to think more about is what are the risk exposures that we have in those portfolios. One way where investors are going to start thinking more carefully is maybe a too limited or simplistic interpretation of what they do is to think I'm going to invest in fixed proportion in certain asset classes that are going to be defined in a very rigid way, and I'm going to be investing 10% on this bucket, 5% on that bucket, and always be invested that way. I think that's not exactly what they do in practice, but that's the way that has been interpreted popularly. And that way of investing might be a little bit misleading because we have a lot of overlapping in the risk exposures of some of these asset classes. And when you don't think through the veil of the name of the asset class and go a little bit beyond that and think more deeply on what's the risk exposure, that's what I think investors are going to start thinking about. And thinking about in terms of what fundamental risk is relevant to me as an investor, and then what kind of exposure do I want to have to those risks, or given my risk tolerance and given my liabilities. And then think more carefully about how, given that I decide to have a risk exposure of, say, 20% to that specific risk class, how do I implement that? And maybe I can do that throughout different types of asset classes. One could be public equities, one could be through private equities, could be through that type of asset class. So I think that's a lesson we have learned from this. I think that's something that the endowments, or the most sophisticated endowments, were actually doing and are doing. And what's going to go away is the simplistic interpretation of what they were doing.
How do you recommend that investors measure risk going forward?
there are going to be three things they need to think about. One is fundamental risk, and what risks are relevant to me as an investor. Investors typically ignore, or have been ignoring in many ways, what their portfolios are supposed to finance. So you are a pension fund, the structure of what your portfolio has to finance is fundamentally different than you are an endowment. You have lots of different issues that or your expenses look very different over time. They are more or less flexible. And given that, you need to think about what are the risks on my liability side and how much tolerance do I have to those risks. So I think the investors are going to start thinking more carefully about that. And those three risks that they really need to think about is, one is inflation risk. Another one is what I would call long-term growth risk, that it would be similar somehow to stock market risk. And another one is reinvestment risk. What kind of real interest rate am I going to get at any given point in time as I roll over my investments? And these three risks are there, but the exposure you want to have to these three risks are going to be different depending on what kind of investor you are. A short-term investor probably has to pay more attention to long-run growth risk because they cannot afford to be there for the long term. A long-term investor probably is more risk tolerant to long-run risk given by the stock market, but probably less tolerant to things like inflation risk or real interest rate risk. And they're going to have an interest in hedging those risks, particularly if you are a pension fund, for instance. So that's one other lesson we're going to learn from, hopefully, from this crisis. We need to be more carefully thinking about there's not just one single type of risk. There are several types of risk. And how do I want to manage my exposure to each risk? To do that, I really need to think very carefully, what is the whole objective of this pool of funds I'm investing? In other words, whether it's this pool of assets supposed to be financed. And pension funds are not the same thing as endowments. Their liability is very different. And so that might drive the way they think of how they invest their assets.
Can I ask you what investment opportunities you see after the credit crunch?
I would like to distinguish between along two dimensions. One is the dimension of, I think it's time to go probably back to basics. I think many analysts agree that equities were extremely, probably very overvalued in the last 10 years or so, even after the bear market we had after the bursting of the internet, the tech bubble. Valuations did not come back to what most analysts would consider normal by historical standards. And after the crunch and the liquidity crisis and the financial crisis of 2008, equities are now back to levels that are fair. Probably are not extremely cheap. I don't think they are, but they look fairly valued. So for long-run investors like young investors saving for retirement, or institutional investors like, say, endowments or foundations, this basic traditional asset class now looks like an attractive asset class where you can go back to normal allocations to that. So that's one type of investment opportunities, which is let's go back to normal. And in a way, for young investors, these are good times because now you can those are the asset classes available to you. And those asset classes finally look attractively priced to those investors. And secondly, we have had huge disruptions in markets in the last year, and that has created a lot of opportunities, quite frankly, in the fixed income markets and other types of markets. And for those investors who are not afraid to go back into alternatives, probably this is also not a bad time. You want to take advantage of those opportunities. One example, for instance, is convertible arbitrage that had performed terribly bad in the last 2 years. And the returns on those strategies are now being very big, mostly because capital has flown away from those strategies. And so in a way, they have created opportunities for capital is not afraid to come back in.
Do you see any bubbles out there in the investment world?
Some people would say, if you believe inflation is going to come back, there is a huge bubble in one market, which is the treasury market. And in fact, people don't realize it, but we have seen this bubble bursting in the last few months. If you are invested in treasury bonds with very long duration, like, for instance, 30-year treasury bonds, interest rates have been coming back lately, and losses on that particular segment of the market has been as big as losses in the stock market, with magnitudes around 30%. So there might be a bubble coming in, which is the excess liquidity demand we have seen has driven the prices of especially U.S. Treasury bonds and in general government bonds extremely high, and are sustainable, those high prices. I think we're getting some indication that might not be sustainable. Interest rates might go back to normal levels or even higher if inflation picks up. And in that case, those investments that did so well in last year, they might be terrible investments going forward. So again, diversification matters. If you are now invested only in treasury bonds because you think that's the safest asset class, you might be out for a nasty surprise.